welcome back to the Mortgage Reports. My name is Arjun Dhingra. I'm a 24-year vet of the industry right here in the San Francisco Bay Area. And I want to talk to you today about the Fed's recent action on cutting rates and what that means for homeowners in the United States or people trying to buy a home. Now, this is a topic that gets messed up a lot, but I'm going to explain it real clear and simple here for you guys so that you will have the best information available to you and not make the same mistake that so many others do. The Fed, which is basically in control of the money supply in the United States, that's their main role. You want to think of them as having control over a faucet that they either loosen and let more money into the system or they tighten and suck dollars out of it. Now, they will do this at two times. When the economy is running too hot or is in a period of high or serious inflation, they will tighten the faucet because we need to suck dollars out of the economy because that's what inflation is. It's too many dollars chasing too few things and therefore the prices go sky high. So they want to take some of those dollars off and cool the economy off, thus lowering inflation. So this is when they hike interest rates. Now, if we're in a period like what we're experiencing now, which is the labor markets are starting to show some weakness, unemployment is slowly creeping up, inflation's coming down, although not quite as fast as they would like, the Fed will loosen the faucet and allow money to enter the system a little easier by way of lower interest rates, and that will stimulate the economy and get it back rolling again. So the Fed rate cut just happened last week. Now, this is the second cut this year, and the biggest mistake that people make is assuming that this Fed rate cut is going to result in lower mortgage rates. Sadly, you will see a lot of people in my industry and in the real estate space that will be talking about the fact that the Fed just cut rates, so now's your time to refinance, or now's your time to get out there and buy your house. Or if you're a seller, the Fed just cut, let's get that house on the market now and get top dollar for it. Well, here's the reality, guys. The rate cut that just happened this week actually resulted in mortgage rates going up. So if the Fed cut rates, what rate is that? The federal funds rate is the rate at which banks exchange money overnight to one another. This is so that the entire US banking system can be liquid. They want dollars to be able to flow back and forth quite freely. Banks need to free up cash, they need to allocate cash, they make trades on this cash to one another, and it keeps the system flush with dollars. So when those rates are cut, there's more activity going on amongst the banks. They then turn around and will lend this money out, at which they set their own interest rates. Now, the federal funds rate has an immediate impact or direct correlation to credit card rates. And if you've been following credit card debt in the United States or you have a credit card, you know that those rates are really high. So there's immediate relief there. It also affects auto loan rates, which have been a lot higher over these last 5 years and now are starting to come down. So this is good for that space. It also has an impact on personal loans or lines of credit, even student loans, but it does not have anything to do with mortgage rates. Mortgage rates will be influenced by inflation. If inflation goes up in the United States, so too go mortgage rates. When inflation cools off, mortgage rates follow suit. They are set and determined by what is happening with the US 10-year Treasury bond. The yield on that bond, which right now sits just below 4%, is what banks will use as a baseline for establishing mortgage rates. They will take that level and then add a margin or a spread on top of it. And that spread can consist of adjustments, oftentimes based on credit score, on the amount of cash or reserves that you have on hand, the type of loan product that you're going for, the down payment that would be applied, and just some general risk layering that the bank is going to have in place. So the 10-year Treasury plus the spread determines the actual mortgage rates. And for the most part, most banks and financial institutions are going to be pretty level. There might be some variance, but you don't see huge difference there. And that's because they all follow very similar formulas. Now, what drives and influences this US 10-year Treasury bond? Well, think of it this way. Mortgage rates really like it when there's bad news going on, whether it's geopolitical news or the economy and unemployment is starting to trend up. And what happens is when you get bad news or shaky situations globally, is money comes out of stocks, which are a little bit more high risk, and they put them into safer places or what is referred to as safe havens. And one of those safe havens is the 10-year Treasury. So when people put money into bonds, it drives the yield or the interest rate on those bonds lower and mortgage rates come down. So that's why we joke around in the mortgage space saying that bad news is actually good news for mortgage rates. And when the stock market is doing really well and things are humming along, mortgage rates tend to creep up a little bit. And that is exactly why mortgage rates went up as a result of this Fed rate cut. This Fed rate cut was done so on the premise that the labor markets are showing some signs of weakness, but not really truly cracking or breaking. They're also operating on very incongruent or incomplete data because of the government shutdown. So they're not getting quite all the reports that they would like to have to fully determine this, but they saw enough with the little reporting that they are getting to justify doing a small 25 basis rate cut because the labor markets are, again, showing a little bit of weakness, but inflation hasn't quite cooled off. In fact, inflation has been trending up just slightly, not at a dangerous rate, but something that needs to be paid close attention to, perhaps as a result of tariffs or just maybe because the US consumer is still still spending money at a very fast clip. So we still have stubborn inflation, but getting under control, a weakening labor market. And as a result, the Fed came out and said, yes, we're doing this rate cut, but that one that was supposed to happen in December, we're not quite sure. As a result, that uncertainty there caused mortgage rates to actually climb a little bit. The mortgage market didn't like that. The mortgage market wanted to hear that there was going to be another rate cut and that it was probably happening because there's some bad news out there, like unemployment getting even higher. So hopefully that makes sense, guys. Bad news is good for mortgage rates. A Fed rate cut does not mean that mortgage rates are coming down, as evidenced by not just this cut, but even the previous one a little earlier this year. And mortgage rates and the federal funds rate are two different planets. So hopefully that distinction is helpful to you guys. And if you want to learn more, get in touch with us here at the Mortgage Reports. Reply back directly to this blog article to learn more, or follow the Mortgage Reports on social media. And you can also follow me at Arjun Mortgage on Instagram. Thanks for listening and reading, guys, and we'll see you on the next report.